Good morning, everyone. A warm welcome to all present for today's webinar on the topic, The Pulse of Healthcare, a Credit Rating Perspective. Before we begin, let me introduce the speakers for today's webinar. We have Mr. Neeraj Rathi, Senior Director Ratings, and myself, Vikrant Chaturvedi, Associate Director Research. Before we begin, let me briefly introduce you to Brickwork Ratings. We are one of India's leading credit rating agencies, accredited by the RBI and recognized by SEBI. We provide independent and credible credit rating, research, and risk assessment services across a wide spectrum of industries, including banking, financial services, infra, and corporate sectors. Let's begin by setting the stage. India's hospital sector is experiencing growth, driven by policy support, rising healthcare awareness, and demographic shifts. About 70% of hospital beds are in the private sector, while government hospitals still account for the bulk of rural healthcare access, creating a dual structured system. Hospitals are a major employment driver. The healthcare sector in India employs over 7.5 million people, with hospitals contributing the largest share of it. Hospitals are rapidly adopting telemedicine, robotic surgery, and AI diagnostics, with digital healthcare projected to transform care delivery and patient management. India is among the largest top destinations for medical tourism, attracting patients from Africa, the Middle East, and South Asia for procedures that cost 60 to 80% less compared to developed countries. Hospitals attract significant FDI inflows, as 100% FDI is permitted under the automatic route in hospital services, making it a hot sector for global investors. The sector reflects both the complexity of a vast population and the promise of a transformative change. In today's discussion, we will start with a quick look at the hospital market, what's driving demand, the main challenges, and how the companies are coming together. Then we'll talk about how credit rating weighs business risk versus financial risk. Next, a snapshot of the financial health of some big hospital players, how profitable they are, their debt levels, and cash flows. We'll also cover recent trends in spending and acquisitions, like new hospital setups and selling of assets. Finally, we will review credit rating history, tracking upgrades, downgrades, and default trends to understand where the sector stands today. After our presentation, we will open the floor for questioning. So please type in to the chat box as we go. Let us discuss the hospital sector overview. India's hospital sector was estimated at nearly 8.2 lakh crore rupees in 2023, and it is projected to almost double, around 16 lakh crore by 2032, reflecting a sustained growth trajectory at a CAGR of about 8%. The government is also stepping up support. In FY25, the government in its union budget allocated over 90,000 crores to the healthcare sector, up 12.6% from previous year. But there's still a big infra gap. India has only about 1.3 hospital beds for every 1,000 people. If you compare that, China has around 5 beds per 1,000, US has about 2.7, and Japan is way ahead with nearly 12.7 beds per 1,000 people. That translates into a shortfall of nearly 2 billion square feet of hospital space. On the demand side, we have several factors: an aging population with over 100 million senior citizens, rising disposable incomes, more urbanization, and wider insurance coverage under schemes like Ayushman Bharat. The private sector is also very active. There's strong FDI inflow, big chains getting corporatized, and even a 2% share of global medical tourism. At the same time, execution delays and regulatory uncertainties are ongoing challenges. I will now hand over the next set of slides over to Neeraj.
Thanks, Vikrant. In the next slide, we have covered the healthcare delivery structure in India, which is typically segmented into three levels. the primary, secondary, and the tertiary healthcare. Primary healthcare centers are the first point of contact for patients offering basic services. Patients are then often referred to the secondary healthcare facilities, which act as catchment hubs and provide both inpatient and outpatient services, including simple surgeries. Finally, we have the tertiary healthcare providers. These are the large multi specialty hospitals that offer highly specialized services and advanced infrastructure. Examples include major corporate hospital chains like Apollo, Fortis, etc. On the next slide, we have covered the key factors in a hospital's credit rating. So, when we evaluate the creditworthiness of a hospital, credit rating agencies generally look at two key dimensions: the business risk assessment and the financial risk assessment. The business risk focuses on operational and competitive strength of the hospital, while the financial risk assesses its financial health and capacity in terms of financial flexibility and borrowing power. The combination of these two profiles ultimately determines the final credit rating. What are the key business risk assessments or the key drivers? Let's break them down in the next slide. We look at four main drivers. On the next slide, the first, scale and market position. A large hospital network with a diverse service mix tends to be more stable. Strong brand reputation, market share, and the ability to attract top medical talent are critical factors. Second, we analyze operational performance and efficiency. Metrics such as occupancy rate, average revenue per occupied bed, and average length of stay are key indicators of a hospital's efficiency. We also consider how well a hospital manages its costs and whether it offers in house diagnostic and multi specialty services. Third, we also consider regulatory and policy risks. There is a heavily regulated sector. The risk of government imposed price cap on treatments, as well as changes in reimbursement policies from government schemes and insurance providers, can significantly impact a hospital's profitability and its working capital. Lastly, location is a critical factor. Hospitals in metro areas often have higher ARPOB or average revenue per occupied bed and face a different competitive landscape than those in smaller cities. On the next slide, we have covered the financial risk factors or the key drivers. The, we focus on three main areas. Next slide, Vikrant, if you could move to Vikrant, if you could move to the next slide.
Yeah, Neeraj, on the next slide.
The next slide, Vikrant. Slide number 7.
Yes. I'm on slide 7.
Okay, so maybe move to the next one where we have spoken about the financial risk assessment.
Sure.
We focus on three main areas. First, the profitability and operating margins. We examine the hospital's ability to generate sufficient revenues to cover its operational cost, especially considering the impact of factors like staffing shortage. Second, we look at the leverage and capital structure. The key metrics here are the debt to EBITDA and debt service coverage ratio. The hospital industry is highly capital intensive due to the cost of real estate and medical equipment. So we need to ensure that debt funded expansion is managed prudently. Third is liquidity and financial flexibility. We measure this using metrics like day of cash on hand. We also evaluate hospitals' ability to manage its cash flows, particularly in light of potential delayed payments from insurers, third party administrators, and other institutional clients. On the business risk assessment, which is covered in the previous slide, we break down. Vikrant, can you move to the previous slide? The business risk factors.
Sure.
uh, the scale and market position, which we have already scale and market position. A large hospital network with a diverse service mix trend is more stable. Strong brand reputation, market share, and ability to attract top medical talent are crucial. Second, we analyze operational performance and efficiency. Metrics such as ARPOB, length of stay, are key indicators of hospital's efficiency. We also consider how well a hospital manages its cost and whether it offers in-house diagnostic and multi-specialty services. Third, we may consider regulatory and political risk. This is a heavily regulated sector. The risk of government imposed price caps on treatment, as well as changes in the reimbursement policy from government schemes and insurance providers, can significantly impact a hospital's profitability. Lastly, location is a critical factor, and hospitals in metro areas often have higher ARPOB and face a different competitive landscape than those in smaller segments. What are the key risks in hospital segment? If we could uh, move to the next, yeah, Ravina. So the outlook, while it seems to be positive, there are several inherent risks in the Indian hospital industry. The first is health insurance. Low insurance penetration means a significant number of patients pay out of pocket, which can affect revenue consistency. Second is competition and site of care migration. Increased competition from new entrants and the migration of profitable procedures to outpatient centers can impact a hospital's average length of stay. The third is regulatory uncertainty with the constant risk of new price controls and regulations. Fourth is raising cost driven by medical supplies, equipment, and inflation. Finally, staffing shortages are a real issue, leading to higher labor cost and potential impact on patient care quality. Now, let's deep dive into the financial health of hospitals in India in the next slide. This slide provides a glimpse into the financial health of the sector. The bar chart on the top left is on revenue and profitability margins and shows that hospitals have maintained steady revenue growth and stable margins over the past few years. This is a positive indicator for the sector's resilience. The line graph on the right hand side or top right on the credit profile demonstrates that in general the credit profile of hospital companies has been improving, which is a very encouraging trend for the sector in general as far as rating agencies are concerned. However, the third graph at the bottom on asset utilization and employee utilization presents an important nuance. Asset utilization has remained stable, employee utilization is peaking. This suggests that hospitals are operating on a near full capacity with their current staff, which could lead to increased labor cost and put pressure on future operating margins. On the next slide, we cover the key performance indicators underlying the revenue and profitability. Here, we look at three key performance indicators: average revenue per occupied bed, which is ARPOB, and occupancy and length of stay. The chart for ARPOB shows that this growth is driven by focus on high value specialties like oncology and cardiology, increase in high end procedures such as complex surgeries, annual price hikes to offset inflation. The graph on occupancy and average length of stay, or ALOS, uh, reflects a positive trend towards a sustained shorter length of stay. There is a result of advancement in medical procedures and better operational efficiency, which allows for a faster turnaround of patients and improved bed utilization. On the next slide, which is we have covered the shifting payer mix. The first graph indicates an increase in DSO, which is a signal to changing revenue mix. This shows a steady increase in days sales outstanding, and this is a crucial indicator as it suggests that revenue mix is shifting away from direct cash payments towards more third party insurance claims, which typically have a longer settlement cycle. The accompanying line graph on health insurance premium reflects significant growth of 16.2% CAGR over 5 years, reinforces this trend, showing robust growth in health insurance premium, which is a key driver for this shift. I would now ask Vikrant to provide an update on the capex trend of this sector.
Thank you, Neeraj. So moving on, let's delve into the capital expenditure. India's hospitals are ramping up investments on multiple fronts. CMIE data shows the value of health services projected commission leaped from 41,800 crore rupees in FY20 to nearly 92,000 crore rupees in FY24, while FY25 dipped to around 74,000 crores. Forecasts for FY26 through FY28 point to renewed momentum. Bed capacity growth tells a similar story. From about 16,800 beds in FY19, additions surged to over 41,000 in FY24. Although FY25 additions moderated to 23,100 beds, projected expansions in FY26 to 28 indicate sustained investment in new and upgraded facilities. The capex cycle is driven by rising non-communicable diseases burden, expanding medical tourism, and broader health insurance penetration. Coupled with government allocations of nearly 960 billion rupees for healthcare infra and medical colleges, the stage is set for specialty services and critical care capacity over the next few years. I'll now hand over to Neeraj sir to take you through the remaining slides.
So, turning our attention to credit ratings, we can see some interesting trends. The rating universe chart shows that the ratings are dominated by investment grade companies, indicating a generally healthy sector. However, the other chart on rating upgrades versus downgrade reveals a more nuanced picture. While there is a balance of upgrades and downgrades, mid-sized companies are beginning to face rating pressure. In the next slide, we speak about the reasons why there are downgrades in the sector. The ratings largely face pressure in the mid segment or mid sized companies, primarily due to three factors. One, high employee cost, low ARPOBs, and therefore lower margins. Two, slower reimbursement rates and recovery of dues owing to unfavorable payer mix, which stretches working capital. And the third one is impact of past events such as debt funded capex or capacity addition at the peak of COVID, which many companies have carried out but are unable to capitalize on the incremental capacity which they have added. So the occupancy remains low while the capacity remains available, and that has led to downgrades in some of the companies. Over to Vikrant for question and answers and remarks on conclusion.
Thank you, Neeraj. Now we will take some of the questions that we received during the registration. So we have received one question. Recent removal of GST on health and life insurance premiums makes insurance cheaper. There are concerns about part of benefit absorbed by the insurers. What are your thoughts? Yes, if you want to answer this.
Yeah, sure. The removal of GST on health insurance makes covers or coverage about 18% cheaper. This boosts affordability and insurance penetration. However, insurers will lose input tax credit on operational costs. This would lead to slight premium hikes as they will have to pass on the benefit, absorb part of the benefit to offset these costs. Overall, policy holders will get a cheaper insurance, but not to the extent to which GST has been reduced on this sector. But the secular trend on insurance or penetration, life insurance and healthcare insurance penetration, is intact and will continue to grow, which we have seen in one of our graphs where we have clocked a 16% CAGR growth for over last 5 years in terms of the health insurance premium as reported by IRDA. That's my take on this.
Thank you, Neeraj. Uh, I don't think we've received any more questions.
So shall we wait for a couple of minutes before we
Sure.
you know, there are no further questions, then
Sure.
Vikrant, we can wind
Yes,
this up. Yeah.
absolutely. So thank you all for your participation today, and we look forward to seeing you in our future events. Thank you.
Thank you, everyone.